for the viewers, I would be looking for something that just comes out of left field. If you remember them announcing Lehman Brothers, nobody knew anything about it. Hi, this is Mike Maloney with Alan Hibbard once again, and Alan has prepared a presentation on what will happen to certain asset classes under the new government. Alan, what have you got for me?
Hey, Mike, I've got a few things. Basically, I want to look at the short-term effect from the election, basically what happened with major asset classes in the week leading up to the election and the week since. And then I want to zoom out and look at the long-term, especially in the gold market. And really, I want to ask the question, is the new presidential regime going to be good for gold or bad for gold or neutral? And I want to answer that question using data. So first, let's dive into the short-term stuff, and then
you've got a list of different assets that we're going to cover too, right? What are those assets?
Yeah, we'll take a look at stocks, bonds, the dollar itself, oil, gold, silver, and Bitcoin.
Excellent.
Yes.
Okay,
So first, I want to give you just a little bit of news, just a little tidbit here. Russia's gold reserves surpassed $200 billion for the first time, now almost a third of their total international assets. So nice chunk of gold for Russia. And of course, as the price of gold climbs, the dollar value here increases. So
this is the trend for pretty much all of the world's central banks except for the West. Am I correct?
Yeah, exactly. And China, of course, is the number one producer of gold and importer of gold. Their holdings have been going up pretty steadily. The US's holdings haven't changed, and I believe Canada is still at zero gold. So I don't know what's going to happen in the long term, but that's the trend we're seeing.
Yeah. Okay.
All right. Well, let's get into some of the charts. So first, I want to start with gold, silver, and Brent crude oil. And this is basically the price of each of these assets in the week leading up to the election. And then this circle is election day, and then the week since. And it's indexed to this point here. Yeah.
Okay, that's what I was going to have you explain, that it's indexed to 100 at election day.
Exactly.
And so the scale here is basically the percentage change.
Mm-hmm. Exactly.
So we're going pretty much plus minus 5%.
Yeah, exactly. So
we're covering.
Yeah, silver started around 105 on an indexed basis and slid down to 100 on election day. That was the index point there, and then kept sliding about another 5 or 6% afterwards. So it basically silver in particular basically followed its trajectory without being disrupted. You'll see that in just a second that some of the other asset classes were disrupted. They were moving one way and then they moved a different way. But gold and silver kind of continued unabated on the path that they were on. Crude oil, in contrast, was rising, right? The price was going up, and then at election day, it started going down. So very interesting. I don't know if you have any thoughts on oil or the other assets.
Yeah, one of the things that I want to mention is that gold and silver were coming off of all-time highs, and it was sort of time for them to take a rest and do a retracement. They had just been, I had talked quite a while ago about the pan and handle or cup and handle that had developed, and in the handle there was a inverse head and shoulders pattern, a triple top that we were about to violate, and I said there would be a slingshot move, and that's exactly what we got, a slingshot move. But slingshot moves can't go on forever. So it was time for them to take a rest and a pullback, but I see a very bright future coming up for gold and silver, and we'll talk about that later.
Yeah, me too. I agree. So I don't think the election really affected them, to be honest. Moving along here, we have stocks, bonds, we have the 10-year treasury, and we have the dollar. So the S&P, you can see, kind of was steady going into the election, but the day before, compared to the day of, compared to the day after, it got a nice boost. So right here around election day, plus or minus 1 day, the S&P had a nice boost and then sort of leveled off. Didn't really do anything notable after that. So I wouldn't read too much into this. And then with the 10-year treasury yield, we probably could have inverted this chart, but that's okay. So it's kind of up and down and up and down all over the place.
Yeah.
Um, Again, the net result here is that yields are increasing, in this 2-week span. I guess we can talk about it more as we go, but obviously what the Fed is doing with interest rates is going to affect this a lot, and the credit rating of the U.S. government is going to be a major factor here. So,
and the dollar is up a little bit, which is usually negative for gold. Gold fell over this same time period that the dollar rose. So
yeah, exactly. So you could see here
but not by much.
Pardon?
But not by much. So
Yes, not by
this
much. You
is
can
the DXY, so this is comparing it to a basket of other currencies.
Exactly. So the dollar fell a tiny bit. This has got to be less than 1%, but then it bounced and rebounded maybe 2%, something like that. So this is one of those assets that was on a certain trajectory, and then after election day, it sort of bounced and went the other direction. So the dollar is strengthening relative to a basket of global currencies, and that makes sense. And Trump and his administration are calling for tariffs and strengthening of the U.S. dollar and so forth.
Yeah, I'm not a big fan of tariffs. When you limit international trade, reduces the risk of war, regardless of how much you may dislike your opponent. If you're doing business with him and your economy relies on him, you're less likely to get into a fight.
Yes, exactly. Yeah, not to mention that tariffs are really a short-term solution to a long-term problem. Which is basically like competitiveness in a global landscape. So, So anyways, maybe we can do tariffs in a separate video. So I want to put all those assets on one chart just in case anybody wants to see them all together. It might look a little busy, but this is sort of a comparison of all of them. And I do want to add Bitcoin as promised. So Bitcoin is the orange line, and you can see that after election day, it took off like a rocket. It is actually off the chart here, the way I have it scaled. So I want to rescale it just a little bit, and you can see just how dramatic this rise in the price of Bitcoin has been in just 1 week. So at one point intraday, it was up 30% from the price of the election in maybe 5 or 6 days, something like that. So pretty remarkable, Mike. Any thoughts on this?
Well, we did a video or several weeks ago, gold, farmland, and Bitcoin. And I think that those are, cryptos and precious metals are part of the places to be. But I absolutely, absolutely believe that the economy is too warped and too out of balance. And those pressures that build up when it's out of balance, that's like an energy potential. And that we are headed for some sort of crisis. I thought it would happen before the election, but is it going to happen between now and Inauguration Day? There are things that are suggesting yes, but I would, for the viewers, I would be looking for something that just comes out of left field. If you remember them announcing Lehman Brothers, nobody knew anything about it. It's just that, here's the Secretary of the Treasury and the Chairman of the Federal Reserve, and they're on TV on a Monday morning announcing the biggest failure in history. And something, if something happens, it'll either have to do, politically or economically, like Lehman Brothers, but it'll be coming out of left field, and so very suddenly, the rush to safe haven assets will change from just a trickle to a flood, is my feeling. So, okay, let's move on.
I agree with you. Yeah, perfect timing. I do want to actually zoom out here because we're focusing on price movements for just a week or two, and it's interesting to think about an entire presidential administration, 4 years or even longer. Of course, as we save for retirement in the long term, we're thinking in terms of decades. So let's zoom out a little bit, and I want to look at basically the two major bull markets that we've had in gold. And I've shown this chart before. Basically, you can see a red box around the gold bull market of the 1970s. and then a red box around the gold bull market that we've really been in since roughly the year 2000, maybe 2001, depending where you start it. And what those two bull markets have in common is that we had negative real interest rates for the majority of those two bull markets.
Yeah.
So, and for anyone who's unsure about what that means, a real interest rate is basically the Fed funds rate minus the CPI. So basically, take the Fed funds rate and subtract the rate of inflation. And when inflation is greater than the Fed funds rate, we have a negative real rate, and that's what I've colored in red here. And basically, my argument is that the bull market in gold is going to continue, regardless of who is president and regardless of their policies, as long as we have negative real rates.
Yeah.
It just seems like such a reliable indicator. Is that kind of your sense as well, Mike?
Absolutely. We know the Fed's playbook. I do believe that there is something else around the corner, and the longer it takes to happen, the worse it will be, because the greater the warping of the economy and the pressures that are building up. And so the Fed's playbook is drop interest rates to zero, create a whole bunch of currency. The currency then creates inflation, and because the rates are being artificially held too low, to try and pump the economy back into bubbles, because that's what they've done for this entire century. All of those negative rates are an attempt to pump bubbles. It started with the NASDAQ crashing in the year 2000, and they do this negative real rate causes bubbles to inflate, and then the bubbles pop, and so they double down on the negative real rates. I mean, you can see that after 2010, the residual from what was happening with the global financial crisis, pumping to get the world economy going again, caused that first big, and then with COVID, the negative real rates there are just insane. And so we know the Fed's playbook. They've been doing it now for more than 20 years. And as soon as a bubble starts to pop, they're going to try to reflate that bubble. And it just keeps the economy warped and causes these booms and crashes to become much worse and more distorted. The booms have been limited to the places where currency creation goes to first. They create a boom in the stock market or a boom in real estate. With low interest rates, it's a boom in real estate. With currency creation, it's a boom in the stock market. It's wherever that currency goes first. If the banks are loaning the currency into existence, that's usually for real estate and for margin loans. If it's the Federal Reserve creating currency through QE, that's just going directly into the stock markets. And so we know the playbook. If anything happens in the economy, this thing will turn red again. So that's my analysis. So it's going to look very much like the 70s, where it's red, gray, red, gray, red, gray, but mostly red. But even more so than the 70s, like it already does look. And until they get things really under control, and they're out of control, this will persist, meaning the bull market in precious metals will persist.
Yeah, my thoughts as well. And you mentioned two things: cutting rates and just running the currency printer, like creating inflation.
Right.
So I actually want to zoom in on those two things so we can see the trends.
Okay.
So the Fed funds rate, was up here at 5.3%, between 5.25 and 5.5. And then we got that 50 basis point cut in the second half of September. And then just last week, we got another quarter point cut, which almost went overlooked. I didn't see a whole lot reported on this. It was
Right.
2 days after the election, we got another, quarter point cut. And, the expectation in the markets from, hearing, comments from the Fed is that we're going to get another 5 quarter point cuts in the next year. So that's the expectation. Obviously, that could change. There's nothing guaranteed about that. But the expectation is to basically lower interest rates by at least another full percent, roughly a year from now. So this is exactly what we're talking about: cutting rates and then creating inflation. So I don't know. Do you think the Fed sees a recession on the horizon, or what do you think they're seeing in order to be cutting rates right now?
Well, they're seeing something in the economy that we are not. The to Also, I do want to say that people think that the stock market rising was solely due to the election results, and but it's the election results plus this little boosting, this tweaking that they gave it. And yes, this last rate cut sort of just like slipped in under the rug. Nobody really noticed it, and so except the stock markets. So
Yeah,
yeah,
yeah, exactly. And there is a greater than 50% chance that we get another rate cut in December. So next month, markets are expecting, I think, maybe a 60 or 65% chance that we get another cut in December. So this is the direction we're moving. We're cutting rates. So negative real rates, that's bullish for gold. And with the CPI, I'm expecting the CPI to start increasing. So, folks who have been paying attention might remember that the CPI, for the most part, has been declining for about 2 years. So, it peaked it peaked in June of 2022 at 9% year over year, and has been falling for the most part since then. Um,
yeah. If you recall, the target is that they only want to steal 2% from you per year, and we are currently at a theft of 2.6%. So they still haven't reached their target yet. They're cutting rates.
Darn, yeah. Um, I mean, the whole thing's a scam, right? So there's a lot I could say
Right.
about it, but it doesn't make sense. Even if you buy their logic, which is nonsense to begin with, even according to their logic, they're not doing what they're supposed to be doing. So it doesn't really make
Yeah.
sense
Yeah.
at all. It's obviously theft. We know that. So yeah. So why do I think that inflation is going to turn around and start increasing? Well, basically, the best predictor of inflation today is the M2 currency supply. Yesterday, quote unquote, or 18 months or 2 years ago. And if we look at M2 from about 18 months ago, we see it bottomed out. So after the COVID, rescue package, you might say, M2 started falling pretty substantially for, a couple years. And that, I think, is the reason why inflation has been falling, since June of 2022, as we just showed, from 9% down to 2.6%.
Yeah.
However, for the last year and a half, the last 18 months or so, M2 has been rising year over year. So that's about the amount of time, roughly 18 months. That's about the amount of time it takes for that currency creation to show up in the CPI. So I'm expecting the
Okay.
CPI to start increasing possibly today, maybe the next print we get, next monthly print. So
Okay,
what's your
so
thoughts?
I'm going to modify Milton Friedman's famous uh, quote then. Inflation is always and everywhere a monetary phenomenon with an 18-month lag. The monetary aspect came 18 months before we see the inflation on the average. So,
Yeah. At
yeah,
least in the CPI. I mean, it shows up in other
yeah,
assets like the stock market and so forth, like almost immediately. So
yes.
yeah. So getting back to that chart we showed a minute ago of like, will the gold bull market continue? Well, that's dependent on negative real rates. I mean, the Fed funds rate is already coming down, and I'm expecting inflation to go up. So I'm thinking the bull market and gold is going to continue, regardless of what Trump or his team does. Kind of pretty much regardless of the policies. I think this bull market continues. There are just larger structural forces at play that are bigger than any one president.
Yes. Okay. Most of this century, the bubble century, I call it, has been an emergency. It's one emergency after another emergency after another emergency. And that's what caused all that red for this century is the Federal Reserve's reaction to one emergency after another. And I do believe that that is going to continue. I believe that the things that Ben Bernanke set in motion with QE and interest rates, and the way, because the way that the Federal Reserve manipulates the economy is very different prior to 2008 and after 2008. Everything changed once Ben Bernanke. So I believe Bernankenomics is storing more energy to cause an even greater crash than was stored before 2008, with the warping, the real estate bubble that we had, and mortgage-backed securities and everything else. We've got a lot that is wrong with the economy right now. And it's interesting, every time something breaks, all of these people that caused the warping say, the free market isn't working, we've got to do something. And they manipulate it, and they set us up for the next big crash. And they have done that. The reaction to COVID, you talked about currency creation. Well, each time they sort of have to double down on it. Look at Powell did as much in the response to COVID as Ben Bernanke did over a period of years in QE1, QE2, and QE3. It was the same amount of the scale of currency creation compressed into just a few months. And so with the deficits that we're currently running, the size of the national debt, everything else, this is going to, the next great inflation of base currency is going to be on a scale that matches the size of the national debt and everything. So it's going to be something we've never seen before, just like the response to COVID was something we had never seen before, just like the response to the global financial crisis of 2008 was something we have never seen before. So get prepared. That's my message.
Absolutely. You said it better than I could. So I want to leave everybody with a meme here. Inflation. Inflation. How big is inflation really? Well, you tell me.